So if I'm audible, you can put it in, you can confirm in the questions box so that I can proceed further. All the attendees, please confirm if I am audible so that I can proceed forward. Okay. Okay. Right. So it seems I am audible to all the participants. So let's begin the webinar. Today we are here to have a webinar on understanding balance sheet and cash flow statement. This is one of the important topics in CFA Level 1 exam. The Financial Reporting Analysis, FRA, carries one of the highest percentage, around 20% in CFA Level 1 exam. And balance sheet and cash flow statement are two important topics from which you can expect around 5 to 8 questions in the exam. Once we know the importance, we can now proceed forward. Firstly, a bit of introduction about us. EduPristine is a leader in trainings for finance, and we are authorized by the CFA Institute, the FRM Institute, and the Premier PRM Institute. And then we serve a marquee client list, which includes JP Morgan, Bank of America, Ernst & Young, IIM Kolkata, etc. About myself, I am Sandeep, and I am in the content development team of EduPristine. So yeah, let's start with the session. Here's the session agenda. First, we'll discuss the balance sheet. We'll try to understand it. We'll look at the components of balance sheet, the presentation formats, measurement of the components, and how the specific assets and liabilities are treated. And then we'll proceed on to the cash flow statement, where we'll see the cash flow classifications, the two methods used to interpret the cash flow statement, the direct and the indirect methods, and then we'll move on to the cash flow analysis and free cash flow to the firms, etc. So I'd like to start the session formally, but before that I would like to again confirm if all the attendees are not facing any problems, any technical issues. So if you can confirm in the chat box, okay, Manish seems to have a problem. He says he cannot hear me. So Manish, if you can use your headset instead of normal listening, it would be better. And try and check your internet connection if speed is a problem. So because I can find other attendees confirming that I am audible, so the problem must be on your side. All the other participants, if it is good to proceed. Manish, is your problem solved? Can you confirm in the chat box? Okay. Okay. So yeah, right. So let's proceed forward. In the first part, we'll cover the balance sheet. So let's start. Balance sheet, as we know, it's also called the statement of financial position or statement of financial condition, because it gives the information about a company at a given point of time. Say a balance sheet of 2005 says whatever the company has till now, whatever the company owes till now, everything, it will be given till 2005. So at that point of time, what the situation of a company is, it's given by the balance sheet. The equation that governs this financial statement is this one. It's pretty simple. Assets are the ones which give economic benefits to the company. Liabilities are something which the company owes to others, and shareholders' equity is the difference between them, the residual thing which is for the owners and the stockholders and the shareholders. So let's start understanding each of the components. The first component is the assets. Assets are the ones, as I earlier explained, they give economic benefits to the entity. So the examples of assets are cash, which is very obvious, I mean, and accounts receivable, inventory, prepaid expenses, intangible assets and deferred tax assets, property, plant, machinery. All these come under assets because they are helping the company to make money. They are going to provide economic benefits. So they come under assets. The assets are classified into two types: current assets and non-current assets. Current assets are the ones which have a life of less than 1 year, like that, like they are liquid enough to generate cash at any time. For example, inventory, cash and cash equivalents, all these come under current assets because they can be readily converted to cash. They are liquid enough. So that's the basic logic behind it. Whereas when it comes to land or machinery or any equipment, they are the long-term assets. They give you economic benefits over the course of more than 1 year, say 5 years, say 10 years. So in that case, they are called non-current assets or long-term assets. So that's the thing about assets. Now we have liabilities. Liabilities, as I said, they are obligations for an entity. They occur from historical transactions. Say you take a bank loan, then you have to pay them back with the interest. So that becomes a liability. Again, here we have two types of liabilities: the current liabilities and the long-term liabilities. Current liabilities are the ones which have to be paid within 1 year. Under this, the accounts payable, the accrued expenses which have to be paid within 1 year, all these come under current liabilities. Any obligation that has to be satisfied within 1 year comes under current liabilities. Similarly, for current assets, any economic benefit or anything which can be converted to cash, which can be easily liquidated, comes under current assets. Again, here the long-term liabilities are bank loans, the deferred tax liabilities, the pension obligations which have more than 1 year of life. So just say come under non-current liabilities or long-term liabilities. Owner's equity, as I said, it's the residual difference, residual amount that remains after we take the difference between assets and liabilities. This has two parts. One is the retained earnings, which is the earnings of the company in that year plus the earnings from the previous years. And the other component is the component that is contributed by the shareholders of the company. So that comes under that includes capital stock, additional paid in capital, treasury stock, etc. We'll discuss all these terms, what they mean in detail as we proceed forward. So nothing to worry about there. So let's see the presentation formats now. There are two common formats of presenting balance sheet. First is the account format, where you have assets presented on the left hand side and liabilities plus equity present on the right hand side. The other format is a report format, where assets, liabilities and equity are presented in just one column. in a in a continuous manner. And the list in which the order in which the assets and liabilities are presented, that again classifies the balance sheet into two types. In case of classified balance sheet, the current and non-current assets are reported separately, and the current and non-current liabilities are reported separately. All the current assets, they are grouped together, and they are reported separately. That's the thing. And in liquidity based format, there is no grouping as in the earlier case. The assets and liabilities are presented in the order of their liquidity. So cash is the most liquid asset, it comes first, and then cash equivalents come, and then accounts receivable come, and then inventory come in case of current in case of assets. So that's an example I took. So similarly, in case of liabilities, we have the presentation in the order of the liquidity. So we have this accrual concept of accounting in case of companies. A lot of companies use the accrual accounting methods. Basically what it means is the revenue and the expenses need not be recognized when the cash is exchanged. They may be earned, they may be recognized exactly, they may be recognized before the cash is received, after the cash is received, or at the time when the cash is received. For example, if you get an income, say rent or interest, which is earned but not yet received in cash, because I have explained these in the last webinar, but then the basic funda here is when the risk is transferred, we say the revenue is earned at the time, whether the cash is received or not. When the risk and rewards, risk of the rewards is transferred, we recognize the revenue at that time, and we create an accrued income which is shown in current assets. So that's the link from the last webinar. And then in case of expense also, even if it is not paid, if there is a even slight chance of having an expense, it is immediately accrued and it's shown in the accrued expenses. So that's the accrual concept of accounting that we are talking about. And then now, as I said, we classify the assets and liabilities into current and non-current assets and liabilities. The current accounts are the ones which, as I explained, are expected to be converted into cash within 1 year in the normal course of business. So in case of assets, these include cash, accounts receivable, inventory, marketable securities, and other liquid assets. The non-current assets are the ones for long-term purpose, to have business activity, to operate the business activity over a course of time. Same with the current liabilities, they are the obligations which need to be paid within a year. Now we have this term working capital. What this basically means is it's the difference between the current assets and the current liabilities. What it means is how effectively are we utilizing the current assets, that is the cash and cash equivalents. Are we able to pay for the current obligations that we have? Say you have 20,000 cash and you have current liabilities of some 15,000. So you are effective enough to satisfy the current obligations that you have. So even after paying the current liabilities of 50,000, you have 5,000 cash in hand, which is which can be good or bad, as I explained now. Not enough working capital may indicate liquidity problems, because you do not have enough cash to currently give your current obligations, that is the current liabilities, so that may indicate liquidity problems for you. But however, if you have too much working capital, again it is not good, because that shows inefficient use of assets, because you have lot of cash with you, but you're not using it, you're not investing it somewhere, you're not getting it, the cash itself is not worth that much. Instead you can put it in a treasury bill, say, and earn some 3% interest at the minimum. So that's why we say cash itself is not an efficient use of assets, having cash itself. So that's the thing. Let's proceed forward. The measurement of assets and liabilities, they are done in two ways. One is they are shown as per the historical value. Say the cost at which, let's take an example of a land. Land, suppose you bought it at $1,000, say, or $1 lakh, say, and that is the cost that you put up in the balance sheet in one method. The second method is fair value, which is subjective, because it depends on the market and the beliefs and the lot of things, a lot of factors come into play. So in that case, if the land value changed to say 5 lakhs today, the fair value becomes 5 lakhs, and the reporting is done at fair value, which is 5 lakhs. So these are the two methods. Historical value, you whatever the records say, you report that. Fair value, it's subjective, it will change over the course of time. So that's two ways of doing it. So when you have to value a firm, or as a financial analyst, you're analyzing a firm, then you have to take all these things into account. The complicated thing is that many companies follow different methods. You have a lot of ways to follow. Say they follow one method for a land and say another method for machinery. So you have to take care of all these adjustments to understand the firm's investment potential and the profitability as an analyst. So let's now look at some of the major assets and liabilities. Before I proceed forward, I would like to check upon all the attendees if they are facing any technical issues or any problems. You can just put up in the question tab if you have any problems, or if I am good to go. If I am audible, please confirm in the chat box. Okay. 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 So yeah, it seems that I am audible to you all, so I'll proceed forward. So inventory is one of the assets, current assets that we discussed. Let's now see how it is presented in the balance sheet. Inventory, basically it has items which are held for sale, which is the finished goods inventory, or to be used in the manufacturing process, which are the raw material inventory or the work in progress inventory. So inventory, when it comes to reporting, it is reported at the lower of cost and the net realizable value. The cost is the amount which includes direct labor, direct material, and the overhead costs, but the administrative overheads and the selling cost doesn't come under this. Net realizable value is the selling price of inventory. Say if you sell in the market today, whatever price that you get, minus the disposal and the estimated cost of completion. So that's a net realizable value as on today. So whichever is the lower one is the one that we report for the inventory. We report the lower value because we traditionally are conservative when it comes to reporting. So we try to show as lower a value as possible. And the costs assigned, they can be assigned in two ways. One is the standard costing, where you have estimates predetermined costs of standard items which you compare and then take care of variances, and the retail method, which is used calculated using the price in the market, sale price minus the profit that you are getting. That gives you the cost that you have incurred. So these are the two methods. Details of inventory will be covered in another chapter, which we are happy to take a webinar of it. If you work, WIP is the work in progress. Anshul has a question here. WIP is the work in progress inventory. It's basically the things. Suppose you have to manufacture a car, then the raw materials will be the tires, the chassis, the engine, everything, and the work in progress will be something which has been done, say 50%, 70% of the complete work. Say, so the finished good is car. Suppose you have assembled some 10 parts, say that comes under work in progress. So I hope I have answered your question, Anshul. So that's great. It's getting interactive, so which is good. And the next one is the tangible assets. In case of tangible assets, we show costs minus the accumulated depreciation. So in case of tangible assets, say machinery, you have depreciation coming into picture because over the life of the asset, they tend to give decreasing returns. So we have to take care of that, and the costs also we have to subtract the accumulated depreciation from that. So the important thing to note here is the cost will also include the installation costs of the machine, say. So in case of intangible assets, there are two types of intangible assets, identifiable and unidentifiable. Identifiable assets are the ones which have finite life, which are purchased with the finite life. Say you bought a patent or a trademark for say 20 years, then those kind of patents are the ones which come under identifiable intangible assets. And the other one, say you have a goodwill. Goodwill cannot be identified and it doesn't have a finite life. It has an infinite life, and it is not something which can be identified even if it is intangible. So goodwill, what it basically means is when you go for an acquisition, it's the excess value paid over the fair value. So suppose you buy a company for some 10 crores, say, while the actual value of the company is 6 crore. So the 4 crore reference will go into your goodwill. Internally generated goodwill, it can only be recognized on acquisition. It's the same principle there. Whenever you have an acquisition or something, you calculate the value of the company and the price that you bought, and the difference will be your goodwill. In case of R&D costs, I forgot to mention this. We have two standards in case of reporting. For the one is the US standard, which is the GAAP. The full form of this is Generally Accepted Accounting Principles. Um, these are the standards that we have in United States, and the other is for the international, all the other countries, which is common internationally, which are the IFRS, International Financial Reporting Standards. So there are both the standards are pretty similar, but and the attempt has been made by the IFRS. Before this, I would like to address a question by DV. What is an internally generated goodwill? How is it generated? That's the question. Internally generated goodwill is, say, your company, when you value in the market, say if it is of 5 lakhs, and when a company is thinking of an acquisition, say it values your company for some 77.5 lakhs, so the difference of 2.5 lakhs will be the internally generated goodwill. It will be internally generated goodwill. Basically, it's goodwill when you try to acquire a company. Say you are thinking of acquiring some smaller company. In that case, you can generate a goodwill, which will be the difference of the price and the fair value of the business acquired. So that's pretty much it. I hope I answered your question. So where were we? I was discussing the two accounting standards. First is the US GAAP, and second is IFRS. The differences, both are pretty much similar, but in case of IFRS, what they are trying to have is a common standard for all the countries, for all companies across the globe. So they are trying to bring the GAAP and the IFRS as close as possible by making some changes. As of now, there are some differences that exist. For example, in case of R&D costs, according to US GAAP standards, all the research and development costs are expensed as they are incurred. So in case of IFRS, what they do is, if we have a research stage and a development stage, in case of research stage, the costs are expensed, and in case of development stage, the costs are capitalized. So that's a difference between the standards. Under GAAP, there are other costs which should be expensed as incurred, which are the startup and training costs, the administrative overhead, advertising and promotion, relocation and reorganization costs, termination costs, etc. So all these costs are expensed as incurred in case of GAAP, the generally accepted accounting principles. The doubt for DV, the internally generated goodwill is the goodwill arising from acquisition. Exactly, that's what I tried to answer you. When you go for an acquisition, there is some goodwill generated out of that acquisition, and when for your company, it will be the internally generated goodwill. So that's pretty much it. The terms are just confusing. It's not really a thing to bother. I mean, goodwill, you just have to remember that goodwill is the excess value paid over the fair value when you acquire a business, and that is an unidentifiable intangible asset, and it doesn't get amortized. This is a point that you have to note. When you have intangible assets, you amortize them. Say you have patent of 20 years, then you amortize it over the life, just like the depreciation in case of long-term tangible assets. But in case of goodwill, since it has an infinite life and it is unidentifiable, it is not amortized. So that's it basically. Let's proceed forward. When in case of marketable and non-marketable financial instruments, the treatment is slightly different. There are three cases here. One is held to maturity type of marketable instruments, trading marketable securities, and available for sale marketing securities. I'll try to explain each of them. But the common things in all these things, all these marketable securities is the dividend, interest income, and the realized gains and losses are recognized in income statement for all these type of securities. However, there are some differences which we'll see now. In case of held to maturity securities, these securities, before proceeding forward, any marketable securities, say a bond, anything that you can easily liquidate. Say you have a treasury bill which of 3-month duration or a 6-month duration. These are the securities that you can buy and can be liquidated very easily within a year. So these come under current assets, and in these we have subclassifications which I am going to tell you now. The held to maturity securities, the debt securities which are required to hold till maturity. Say you buy a 1-year bond and you are ready to hold it till 1-year maturity, then that comes under held to maturity securities. Such kind of securities are reported at amortized cost on the balance sheet. So in this case, what basically the difference is there are no adjustments for the change in market value. So say the bond value changes over the course of time. Those effects are not taken into consideration since we are keen to hold to maturity, so we only report it at amortized cost. What amortized cost means is you have the cost and subtract the accumulated depreciation or amortization, and the remaining value is the amortized cost. It's basically the historical cost minus the accumulated depreciation or the amortization. The second class of marketable securities is the trading securities, wherein you have securities which are acquired to profit over the near term. These held to maturity securities are generally long-term securities, and they are held till maturity. Whereas trading securities, you try to profit over the near term by trying to sell when the price increases and trying to buy them when the price decreases, something like that. Overall, you try to make a profit out of them and you try to trade them, unlike the held to maturity securities, which you try to hold till maturity. So in this case, they are reported not at the amortized cost but at the fair value of the balance sheet. So fair value is the value in the market that you have of the security that is trading currently. So obviously the changes in market value will affect the fair value, and hence they are taken into consideration and are reported in the income statement. Suppose you have a gain, then they are reported as unrealized gains, and if you have a loss, they are reported as unrealized losses. And the third class of securities is available for sale securities. Uh, Here what is done is, again, they are not expected to be held to maturity or traded in the near term, and they are readily available for sale. In this case, the only difference is that they are not recognized in the income statement, but are reported in the other comprehensive income as a part of stockholders' equity. Instead of reporting as unrealized gains and losses in the income statement, they are reported in the other comprehensive income, which comes as a part of stockholders' equity. So let's take an example to understand these things. Suppose you have a 5% annual coupon bond with a 10-year maturity, with a face value of this and market value as given. What is asked is the yield to maturity is 6% is given, and the impact on financial statements is to be known if the bond is classified under the three ways that we have discussed now. So here's the solution. The thing is, in case of held to maturity, the bond is reported at amortized price, so which is the $100 as we saw in the question, which is given in the question here. So let's try to look at this in a more detailed way. So when you have market value of $1 lakh or 100,000, it is reported in the balance sheet as it is. The changes in the market value is not taken care of, and the coupon income, which is for 3 months, because as in December we had $100,000, and interest is paid on every 31st March, which is 3 months of an year, which is 1/4 of an year, or 0.25 of an year. So the coupon income will be 0.25 into 5% that is paid annually into $1 lakh, which is the market value. This gives the income, and it is reported in the income statement. In case of available for sale security, the market value as it changed, because the bond price changed on March 31st. The calculation of this is a bit complex, and we'll see the calculations in another webinar. For now, let's assume we know the value, the changed value, which is 92.74 on 31st March, which is different from the 100 at the start of the period. So the market value also has changed to 92,749. So this is reported in the balance sheet in case of available for sale securities. In held to maturity securities, although the price changed, we report the market value as $1 lakh itself, not 92,749, which is a new value. And the coupon income is, of course, reported on the income statement. Also, the unrealized loss of this difference, which is 7,251, is reported in the other comprehensive income as part of shareholders' equity. In this case, whereas in case of held for trading, it is reported in the income statement itself, this unrealized loss. And the remaining things are as similar to available for sale security, except that we report the unrealized loss also in the income statement. So the final component of the balance sheet is the shareholders' equity. Uh, the shareholders' equity consists of common shares, preferred shares, treasury stock, and the retained earnings. We'll look at each of these things in details. So in case of common shares, we have authorized shares, issued shares, and the outstanding shares. Authorized shares are the number of shares that the company can issue at max. So suppose a company is given a permission to issue shares of at max 1 lakh. So authorized shares will be 1 lakh. Among them, the company issues say 70,000. So that will become the issued shares, and the outstanding shares will be the ones which are not reacquired by the firm, so which are entirely outside the firm. Say out of 70,000, if you have 50,000 that are owned by the normal stockholders, and 20,000 are the stocks which are reacquired by the firm, then these 20,000 are called the treasury stock, and the remaining 50,000 shares are called the outstanding shares. Now, contributed capital is the amount contributed by common and the preference shareholders. The difference is that in case of preference shareholders, they have certain rights and privileges, and the basic term, the preference shareholders mean that means is they are given preference when you liquidate the company. So whenever you liquidate the company, when you try to pay, the first preference is given to the debt givers, and then given to preference shareholders, and finally the preference is given to common shareholders. So that's the difference. They also get a dividend at a fixed rate, irrespective of the profitability of the company. So that's the difference. Retained earnings are the ones which are the earnings, cumulative earnings from the operations till today. So that's one component of shareholders' equity. In case of balance sheet, we have common size balance sheets. For the analysis, we use either common size balance sheets. We use common size balance sheets. Among these, we have two types: vertical common size balance sheets and the horizontal common size balance sheets. In either case, in vertical common size balance sheet, what we try to do is we try to express everything as a percentage of total assets. So here's an example of vertical common size balance sheet. As I said, these are the assets: cash, account receivable, inventories, and fixed assets, which are the long-term assets. So across years, they are reported, and they are reported as percentage of total assets. So cash is 9% of total assets in 2009, while it is 7% of total assets in 2010. So in a similar way, we have liabilities. Everything is as a percentage of total assets. And so that's the thing. Again, we have horizontal common size balance sheets. In this, what we do is across the years, we try to take the starting year as one, and we try to look at the relative change in each of the items. So cash, in the first year we put all the items as one, and in the next year we try to see the relative change in each of the items. So here, say in 2010, the cash has become 1.1 times, the accounts receivable has remained the same, the inventories has become 1.7 times. So that's essentially the insights that you get from this horizontal common size balance sheet. And in vertical balance sheet, we can see the liquidity and solvency position of the company. Say you have less cash in hand, they can say the company is less liquid. The the company may have liquidity problems. So that's how basically an analyst thinks when in case of these things. So here are some questions for practice. I later mail this PPT to you all. You can have a look at these questions and practice. These questions are on par with the CFA level 1 exam. So if you practice them, it will be quite useful for your preparation. So let's move on to the second part now, which is the cash flow statement. So let's understand the cash flow statement now. This is another financial statement which is of utmost importance. I have already taken a webinar on income statement which I have discussed in length in detail. You can have a look at them at the other webinars on our site, which is edupristine.com/webinars. Apart from this, we have a lot of other webinars coming up, and we had several webinars that were already taken, so you can have a look at all of them. So cash flow statement. Cash flow statement, what it basically says is your cash, only the cash flow, not the other assets, not the other liabilities, only the current asset. The most liquid current asset, which is the cash, how it is flowing inward, how it is flowing outward, at what time, everything is given in cash flow statement. So it is used to know whether your regular operations generate enough cash to sustain the business, whether you need any additional financing, how much operating income are you generating, how you are meeting your obligations. Everything can be known from the cash flow statement. In this, all the receipts or payments of cash flows are divided into three activities, which are the operating activities, the investing activities, and the financing activities. So let's see each of them in detail. At this point of time, before that, I would like to confirm if I am audible and if I am good to proceed forward. You can confirm in the chat box so that I can proceed forward. If there are no problems, just put an OK or audible or whatever so that I can know and I can proceed forward. Okay. 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 So yeah, the attendees, it seems that I'm audible. So I'll proceed forward now. Here we'll look at operating, investing, and financing activities in detail. Again, we have US GAAP standards. According to this, we see the cash flow classifications. The operating activities include the actual operations cash flows that are generated. So the cash that is generated from sales or revenues, the cash that is collected from customers, the sales of trading securities, cash collected, the interest and dividends received, all these come under cash inflow. There is slight difference between US standards and IFRS standards, so I'll discuss them later. For now, these are the cash inflows that come under operating activities, and the outflows are these things, which are the purchases that you make, the money that you pay for suppliers, that you pay employees, that you pay as taxes, that you pay as interest. All these come under operating activities. The investing activities, in case of GAAP standards, the income generated from investments in, say, other companies, stocks, or in other acquisitions, those are the ones which come under this investing activities. The money that you put up come under investing activities, while the income generated in case of GAAP comes under operating activities. In case of IFRS, the income that you generate can be put in either operating or investing activities. So the typical cash inflow activities that we have here can be the cash collected on sales of debt and equity instruments, cash collected on sales of long-lived assets, all these investments that you make on long-lived assets and other things. So debt and equity investments, so that come under investing activities. The cash flows outflows will be when you buy a long-lived asset or when you buy a debt and equity investment and when you give loans to others. In case of financing activities, they are related to the capital structure of the company. Whenever you issue equity, or say when you issue debt, or when you issue preference shareholders, anything that comes under issuance of shares and that can change the capital structure of the company, those come under financing activities. So that's basically it. Non-cash activities like stock dividends or exchange of debt for equity, convertible debt, all these don't have a place in cash flow statement, as these do not involve any exchange of cash. For example, in case of stock dividends, you give additional stocks to people, which doesn't really result in any cash, additional cash that you get. So that is not represented in a cash flow statement. So all these they must be disclosed in either a footnote or a supplemental schedule to cash flow statement for the analyst to analyze the statement properly and to take care of all the adjustments that we have. So here are some key differences, as I mentioned earlier, between GAAP and IFRS standards. The differences are in terms of treatment of dividends, interest paid, and taxes. In case of US GAAP, the dividends paid to the shareholders are reported as financing activities, while interest paid is reported in operating activities. Similarly, the interest received and dividends received from investments are reported as operating activities. In case of IFRS, all these activities can be either operating or investing activities. And so similarly, in case of taxes, all taxes are reported as operating activities in case of US GAAP, while a firm can report investing inflow net of taxes under investing activity. So what this basically means is, here's an example. A company sells one of its buildings with a book value of 3 million for a price of 4 million. The taxes is $350,000. So in case of US GAAP, it shows an inflow of 4 million and an outflow of 350,000. However, in case of IFRS, these two cash flows can be netted, and only an inflow of $3,650,000 can be reported directly. So that's one of the key differences in these two standards. So now let's move on to direct and indirect methods of cash flow statements. We have two methods of representing cash flow statements. In case of direct method, we directly show only the cash receipts and payments directly. We don't see the impact of other accruals. So in case of direct method, here's a typical cash flow statement for your understanding. here we directly have cash sales or revenues, the cash collected, interest and dividends received. These are the items that I earlier mentioned for you as operating activities. So I put up some values for them for your understanding. So directly we take all of these and try to find the operating activities, and then here are some basic formulae to calculate all these. For example, to find out cash collections, we take the sales, and we take the difference of the accounts receivable balance, so that we get how much cash is paid for the sales that took place. Similarly, we can find other expenses and income using the formula that I have mentioned. So that's it. In case of indirect method, basically the difference between direct and indirect method is only in terms of operating activities cash flow. The investing and the financing part is the same in both the cases. Only in case of operating activities. In case of indirect method, what we do is we start with the net income, and then we add back the non-cash items, and then we take the differences in the working capital, and we make changes accordingly. So in the example that we have, if we try to interpret it in terms of indirect method, what we do is we first start with the net income. We subtract, we add back depreciation and any other non-cash items that we have taken early on, so that we exactly get the cash flow of the operating activity accurately. So these are the changes that took place in working capital. Working capital, as I said, it's the difference between the current asset and the current liabilities. So if we have any differences in these terms, so we take care of all these. Say accounts receive, an increase in current assets is subtracted, whereas an increase in current liabilities is added. So that's the thing that we have to remember, and using that we can get the operating activity cash flow, which is the same as what we got in case of direct method. So indirect method only presents the net results of these receipts and payments, whereas direct method gives the complete detail. So indirect method focuses on net income and operating cash flow, thus providing a link to income statement when forecasting future operating cash flows. So the important thing is all these financial statements are linked. So let's see how cash flow statement is linked to the other two financial statements, which is the income statement and the balance sheet. It is linked to income statement through net income. So the net income is the one which is taken from the income statement and used for the calculation of cash flows. And in case of balance sheet, we have linkage with each asset and liability. Say you have machinery, you bought a machinery, so the money that you used, the cash that you paid comes here. So that's the link between the balance sheet and the cash flow statement. For example, an increase in a liability is a cash inflow, whereas a decrease in liability is a cash outflow. So thus all these statements are linked. Now let's look at some of the basics of cash flow analysis. In this, when you have a negative operating cash flow, then there is a question mark on the sustainability of business. So what that means is you are not able to generate enough cash to sustain the business. So that way, as an analyst, you can say the business may not be sustainable, or that way you can analyze it. So thus this statement helps you find out the situation of a particular company. Similarly, if the earnings are stable over the years, so we can say the company is in a better position. And if you have low cash flow when compared to earnings, you can say aggressive revenue recognition policies of the company. So these are the results that you can interpret using the cash flow statement. Similarly, we can use a common size cash flow statement wherein like the balance sheet, we have all the items expressed as a percentage of revenue here. So here's an example of a common size cash flow statement. These are the percentages that I'm talking about. All the items are expressed as a percentage of net revenue. So here we can say there is a decrease in accounts receivable, there is an increase in operating activities, cash provided, so which is good. So that way we can analyze the company. Finally, free cash flow is the amount that is available to all the investors, both the equity owners and the debt holders. So when you find the cash flow, the final cash flow that you get, you make some changes to it to find the free cash flow to the firm and the free cash flow to the equity. The free cash flow to the equity, FCFE, is the cash available only to equity owners, while the FCFF is the cash available to all the investors, both the equity owners and the debt holders. To calculate FCFF, we have the simple formula: cash flow from operations plus interest expense into 1 minus T. This is to take care of the tax benefit that you get, and you subtract the fixed capital investment to get the FCFF. Similarly, to get FCFE, what you do is additionally you take care of the debt. Thus, you take the difference of debt issued and the debt repaid. Basically, this eliminates the debt portion and only has the equity portion. So that's the free cash flow to equity. So here are some more questions for your practice on the cash flow statement. I'll send you this PPT. You can have a look at these questions. Because of the lack of time, I'm not discussing them, but you can very well go through them, and I have the solutions too for you in case you have any questions. So here are the links for the blogs of the other recent webinars that we had on the CFA and the FRM level 1 preparation. So you can find many other blogs on our site, edupristine.com/blog. These can help you with the summary of the topics that we discuss here, so it will be very helpful to read them. And we have a lot more webinars coming up. You can just mail us the topic, any topic you want, so for us to have a webinar on. We'll try to address all the topics that you give us. So you can check for the updates of the webinars on our site, edupristine.com/webinars. So therein you can find the upcoming webinars as well as the links of the videos for the previous webinars. You can also find the links for the quizzes on these topics, which will help you know where you stand as of now. And finally, I would like to mention that we as of now are in India, but we are now coming to UK and US. We are starting classroom training in New York, Boston, and Chicago in US, and in London in UK for both CFA and FRM programs. We have 4-day review course for FRM exam and 4-day CFA review course. So For more details on the courses and to enroll for them, you can go to our site edupristine.com/courses. So here are the links for that. We hope through these free webinars we can help you all. So if you have any questions, you can put in the questions tab regarding the discussion that we had today, webinar that we had today. So I'll wait for some 2 minutes for your questions. If you are all clear, it's well and good. You can have a look at the PPT once again. I'll mail you. I have the email ID. Sanchul has provided his email ID too. So yeah, I'll definitely mail you all. So you can have a look at the PPT again, and you can practice the questions that I have given in the PPT. All these questions are on par with the CFA level 1 questions. So some of the questions are also previous paper questions, previous mock test questions. So that's pretty much it. If you have any questions, or else it's time for me to sign off. So yeah, all of you are asking to send the PPT, so I'll send it. So yeah, signing off. Look forward for many more webinars from our side. You can register. You can have a look. Once again, I'm mentioning the link, edupristine.com/webinars. You can find the links in the PPT that I send you. So all the best for your preparation. Thank you for the patience. Signing off. So yeah, thank you one and all.